Welcome to the lecture on risk and return. Big picture, where are we in the class? If you recall at the very beginning of the semester, we said that everything in this class is going to relate to the present value formula. In one way or another, we can tie it all the way back to that very simple formula. Okay, so here it is. Present value is equal to the cash flow divided by 1 plus r to the t. Up till now, we've focused on the cash flow. Right? We studied annuities and perpetuities. Those are all different types of streams of cash flows. We used accounting data to calculate free cash flows. We've done some sensitivity analysis, and we've used real options to think about changing our assumptions on the cash flows, or what happens if the cash flows can change dramatically over time. Right? Everything's been focused at root on the cash flow. So now we're finally going to turn and think more about the discount rate. In the past, we've just been given a discount rate, and we've used that in this present value formula. But now we want to think a little bit more rigorously and precisely about this discount rate, see where it's coming from and how we can measure it. So here's the outline for this lecture. We're first going to lay out the intuition behind risk and return. Okay, what's the relationship there? It's not so simple as to say that more risk will give you a higher return. I think that's kind of an intuitive feeling, a visceral sense that we have, but it's not quite correct. So we have to talk through the intuition a little bit more carefully. Talk about the different types of risk. Only some types of risk will earn a return. You can't go to a casino and earn a return. Right? It needs to be a particular type of risk in finance that generates a return. And we'll talk about diversification as a way to eliminate risks that don't earn a return. Next, we'll turn to the second portion of the lecture, which is the capital asset pricing model. We need to have some way to measure systematic risk and to think about it precisely. The CAPM, as it's called, is one way to do that. It's kind of the workhorse model in finance for measuring systematic risk. So we'll go through the definition of the CAPM. We'll do some very simple examples. Then we'll see how you can estimate these parameters for any stock that you want. You can just go to Yahoo Finance, pull some returns, and use that to estimate any stock's cost of capital that you want. With the definition and kind of the basics in hand, we'll then think about the more fundamentals. Think about kind of economically what drives the beta of CAPM, what drives the parameters in this model. And finally, we'll end with some caveats that we should keep in mind, some kind of more subtle points when we use the CAPM. So big picture again, we're turning toward the discount rate. Up till now, we've kind of waved our hands a little bit, and I've just given you the discount rate. We haven't really honed in on where it's coming from. So we need to be able to measure it. We need to be able to measure that return on the next best investment. Right? We said that the opportunity cost of capital is what you could earn on something of similar risk. It's kind of vague. We want to be much more precise about it now. The short answer is there's not one clean way to estimate the opportunity cost of capital for every company. There's an entire, basically half of finance academics are thinking about this and writing papers about how to do this better. But we have a workhorse model. We have the CAPM. That's the starting point everyone uses. It gives us a lot of bang for the buck. So that's where we're going to go today. And that's all we're going to use in this class. We'll use the CAPM to estimate the opportunity cost of capital. We'll start with the broad intuition. What is the relationship between risk and return? To help us think about this, I plotted the cumulative returns in a few different investments. So you take $1 and you invest it in 1926, okay, and you just hold it through 2017. If you put that $1 in the stock market, that's the gray line here, that $1 grows to almost $10,000, maybe $8,000, something like that, by 2017. Okay, so about 90 years, you're multiplying $1 8,000 times over. If you put that $1 in the treasury bill, so that's a government debt, kind of short-term government debt, very safe. Like the government's definitely going to pay you back. They're definitely going to make good on their promise to you. So if you invested in treasury bills, kind of roll over your investment every time the treasury bill pays you money back, you keep rolling it over. That $1 is going to turn into maybe $15 at best, okay, over 90 years. Okay, so you're multiplying your money by 15 times. That's not bad, but it's not as good as 8,000 times. It's much worse than multiplying your money 8,000 times, obviously. Okay. And then the third investment I plotted was a fictional casino. Like you go and every month you bet on a coin toss. And if it's heads, you get a positive return. If it's tails, you get a negative return, kind of equal proportion. So it's an equal odds casino. It's just a fiction, right? You're never going to see this in the real world, but just to illustrate what would that look like? And maybe not surprisingly, you start with $1 and you're taking all of these bets. Sometimes you get a little bit lucky and that $1 grows, but then sometimes you get unlucky, the $1 falls, and you're left with about where you started. You didn't earn any return. However, you can take a lot of risk that way. If you look at the wiggles in this line, right, those are proportional changes. So I should mention that this is a log scale, right? We have $1 here, goes to 10, 100, 1,000, 10,000. So we're up to $8,000 for the investment on the stock market. Because this is a log scale, that means that little changes, little wiggles, those are percentage changes. So an equal percentage change will show up as an equal movement on the log scale. So that means that the casino is the most risky that we have here. I calibrated it so it's somewhat similar to the stock market. The wiggles on the casino look somewhat similar to the wiggles in the stock market and the casino. So you're still taking a lot of proportional risk in the casino, but you're not getting any return from that. So the question is, can we explain these three lines? Can we kind of triangulate the relationship between risk and return using these three investments? Now, the natural way to explain the difference between the stock market and the T-bill here, think about this, why did the stock market go up so much more than the T-bill? Well, the natural answer students are going to say is it's risk, right? You take more risk in the stock market than you do with T-bills, therefore you get a higher return. And that's partially true, but it's missing something important. How do we know it's missing something? Well, because you can take the same amount of risk in a casino and not earn any return at all. So it can't just be that the risk is higher and that's why you get a return. There has to be something else. So another explanation, students will say, well, the casino, that's just a synthetic risk, right? You're just going to the casino and you're just creating risk artificially. There's nothing real there. Okay, you can find your friend and bet on coin tosses, but it's not tied to anything real. It's just you created a risky contract that you both agreed to, but it's not tied to the real, any kind of real asset. And that's also true. Okay, that can explain the difference between the stock market and the casino, but that can explain the difference between the treasury bill and the stock market. Right? You can invest in very safe real assets. Right? The treasury bills are backed by tax revenues, or you can invest in corporate bonds, for example, which are backed by companies' operations. If you do that, it's backed by something real, something fundamental to the economy, but it still doesn't get a very high return. Right? So even though it's tied to something real, it doesn't necessarily mean it's going to get a high return. Okay? And likewise, just because there's risk also doesn't mean that it's going to get a high return. Okay, we need to have a little bit more of a subtle explanation between these three things, these three investments. Another approach sometimes students will use to explain the stock market is they'll say, okay, stocks are backed by companies, and we know that companies grow over time, right? The assets are generating cash flows and they're growing the assets over time. So if you own stock, you get paid a dividend today, and that dividend we know is going to grow over time, and maybe that's why the stock prices grow. Maybe that's why you earn a very high return on the stock market and not on the T-bill, which doesn't generate growing cash flows the same way a stock would. That's not quite right either. That explanation doesn't quite work. So let's pull up the whiteboard here to see what's going on with that explanation. This may be one thought that you have as to why stocks earn a higher return, because the dividends are growing. But remember our constant dividend growth model. You get the price of a stock today, that's equal to the dividend in a year, divided by the return on the equity to the stock, minus the growth rate in the dividends. Okay. If you say that the dividends are growing over time, that's fine, that's true. That's accounted for in G. In the growing perpetuity formula, that shows up in G here. What we're after is R, right? R is the return you get from holding the stock. The fact that G is high, the fact that G on dividends is higher than G on treasury bills, that can't explain R. Okay. G should be priced in separately from R. So taking a step back, what do I mean? Investors know that the dividends are going to grow. So that means that that growth should be priced in the stock price. Okay, it should be part of the stock price today when investors are forecasting the dividend growth. If that dividend growth is incorporated in the price today, then that doesn't mean that the price is going to grow over time, right? Investors already know the dividends are going to grow, the cash flows are going to grow, so it's already in the price. It doesn't mean that the price is going to grow going forward. That's what I mean when I say that the growth in the cash flows is picked up by G, and R is something separate. We need to be able to think about R as a separate thing. Okay, so that's not quite going to do it. Okay, it's not just that the cash flows are going to grow. We've touched on a few possible answers. We've said that we have some guesses for why the stock market earns a high return. Say, well, maybe it's the risk, except the casino also takes risk. Say, well, maybe it's that it's tied to something real, except corporate bonds and T-bills are also backed by something real. So what we need is something that connects both risk and the real. Okay. So the stock market earns a return because it's risky and it's tied to the real economy, right? You need both of those two things together. They're risky in a way that is tied to the real economy. That's how we can triangulate these three types of investments and explain why the stock market can earn a high return relative to the T-bill and a casino. Okay, so why does the stock market outperform the T-bills? The risk is what we call systematic. Okay, it's tied to the real economy. So in words, stocks are riskier, yes, but they're riskier in a very particular way. They're riskier in a way that connects to the entire economy, to this systematic risk, we call it, okay, which is different than going to a casino and taking a synthetic risk that way. When you own stocks, it makes the good times better and the bad times worse. Okay? That's the key. So when everything's going well, you just got a promotion at your work, your house price is going up. You look in your brokerage account, you check out your Fidelity or your Vanguard account, and you see, oh, my stock portfolio is also doing well. It's kind of icing on the cake. Right? Everything else is going well, so you don't really need the money. You got the promotion, you're increasing your clients, whatever. Everything's going well. You don't need the money, but it's there for you in your brokerage account. Your stocks are also doing well, so it's nice, but you don't need it. Conversely, when everything's going badly, so you just got laid off, your siblings move in with you. They don't have very good opportunities, so they crash at your place, and you're very crowded. Everything's going bad at the same time for everybody. Then you pull up your brokerage account, you look in your Vanguard account, and you see that your stock portfolio is getting crushed. Right? At the very moment where you really want the money, where you really need it, it's not there. That's the sense in which stocks are riskier than going to a T-bill or going to a casino. They're riskier in a way that's tied to the overall economy. And that's very painful. It's very painful to bear that risk. And so if you're going to bear it, you need to earn a return as compensation. And you can see this if you plot returns over time. So in red, we plot the stock market returns for every year. In blue, we plot the returns on the T-bill. We see that the T-bill's pretty constant. Right? When inflation goes up, the T-bill returns also go up. But generally, you're always going to get a positive return on the T-bills, so it's a very safe investment. The stock market, however, we get some very good years, we get very high returns, but then we get crushed in some other years. And when do we get crushed? It's exactly at the time when everybody's hurting. Right? So we get the Great Depression in the early 30s, and then when the Great Depression kind of came back and had this double dip in the late 30s, we have it during the period of stagflation, the recession of 1973. Again, lots of bad things going on at once. We have it with the S&L crisis in the late 80s. A lot of banks are failing. We have it in the dot-com bubble, so several years of negative returns here when valuations are getting hammered here. Everything's going bad. We have a recession in early 2000s. And then, of course, in the Great Recession in 2008, we have lots of people losing their homes and foreclosures. That's the exact time when you look in your stock portfolio and the money's not there, right? At the same exact time you need it to save your house, the money's not there. Okay, so you can see pretty plainly when you lay it out like this that the stock market falls when you really need the money. That's systematic risk. That's why it's so painful to bear, and that's why you need to earn a return to bear it. I want to spend a little bit more time breaking down the different types of risks that you can see in the stock market. Sometimes the stock market is compared to a casino, and there is some truth to that. You can take casino-like risks when you're betting in the stock market. However, we can get rid of that risk through diversification. So when you buy an individual security, let's say you buy a share of Tesla. Let's say you put all of your money into Tesla. You're taking a lot of risk. You're taking a lot of risk that is unique to Tesla, and it's kind of like going to a casino. You can get rid of all that risk through diversification. The idea is if you put all of your money on kind of one coin flip, say you double your money if it's heads and you lose all your money if it's tails. With one coin flip, you're taking a lot of risk there. Conversely, suppose you take 100 coin flips where each coin flip is only like a 1%, 1% of your wealth. Instead of putting all of your money on one coin flip, you put 1% of your money on 100 different coin flips. Well, what's going to happen? If you flip the coin 100 times, about half the time you're going to earn 1% of your wealth. The other half of the time you're going to lose the 1% of your wealth. And so on average, they're going to net out. Okay, on average, nothing's going to happen. Right? This is something called the law of large numbers, the central limit theorem. Everything just kind of converges to zero very quickly through the fact that you're taking a bunch of different bets. So we can eliminate a lot of that casino-like risk in the stock market through diversification. We're not going to be able to eliminate the systematic risk. The systematic risk is what earns a return, so we can't eliminate that. But we can get rid of a lot of risk. Okay, so thinking about this more carefully, when you buy a stock, there's lots of different risk that you're taking. Okay, put all that together, call that the total risk. Okay, so for any given security, there's lots of different things that can move that security's price, and you're exposed to all of it when you buy the stock. We can decompose the total risk into two pieces. The first is the systematic risk. That's the risk from exposure to the entire economy, and this affects everybody. Right? Now, different stocks are going to have different levels of systematic risk. We'll talk about that when we introduce CAPM, but everybody has some systematic risk. Because it's the exposure to the entire economy, we can't get rid of it. Right? That's not going away. Sometimes this is called non-diversifiable risk. We can't get rid of it. Sometimes it's called market risk. The idea is the same. It's affecting everybody. It's affecting the entire market. If it's not systematic risk, then it's idiosyncratic risk. This is just by definition anything that is not systematic. It is not tied to the overall economy. It could be that it just affects one company, or it could be that it affects just like a small subset of all the companies, right? But it's not hitting everybody at the same time. Now, these risks are like those coin flips. They're pretty small. They're a small part of the overall economy. So what you can do is you can just buy a lot of different companies, take a lot of those coin flips, and those idiosyncratic risks start to cancel out. They can be diversified away by owning many different assets. So sometimes this type of risk is called diversifiable risk because you can get rid of it with a portfolio. Idiosyncratic risk, a unique risk if it's unique to one company or a subset of companies. Or I like to think of it as the casino risk. It's the analogy that people use when they think about the stock market as a casino. That's this idiosyncratic risk. To help us think about these different types of risks, I want to consider Google and McDonald's, and we'll think through the different things that can move the stock price for each company. And then we'll consider what happens if we take a 50-50 portfolio. The portfolio has, say, one share of Google and one share of McDonald's, or it's dollar weighted, so maybe $100 in Google, $100 in McDonald's. In this figure, we're plotting what happens to $100 invested in Google, that's the blue line, over time from July 30th, 2010 to July 30th, 2014, or it looks like the end of 2014 rather. So blue is Google, red is McDonald's. At $100, you put it in McDonald's. And then the green line is a mix. You're putting $100, $50 of that you're putting in Google, $50 you're putting in McDonald's. You see lots of different wiggles, right? Lots of different things are moving Google, lots of different things are moving McDonald's. So let's focus on those wiggles a bit and think about the things that can move both prices. Okay. So I have this table set up. Want to brainstorm, think about the things that can move McDonald's, compare that to what can move, say, Google. The main thing that's going to drive McDonald's stock price is how much people are spending at restaurants. They could eat at home, or they could go to a restaurant. And McDonald's is obviously going to do better when people are eating more at the restaurants. Another thing you can think about are, say, new products. So when McDonald's introduced all-day breakfast, that was kind of a big innovation. It's kind of a test, right? Are people going to pay more money to McDonald's if they can buy their sausage, McMuffin all day? If these new products do well, then that's going to move McDonald's price up. If they kind of flop, then that's going to hurt McDonald's stock price. Then we can get into kind of very specific things we can think about. You may not remember but in 2004, there was a documentary called Super Size Me. And this documentary was made by Morgan Spurlock. He decided to eat McDonald's 3 times a day, breakfast, lunch, and dinner, every day for like a month, something like that. And it was kind of a disgusting experiment, and then he videotaped it. And then lots of people saw it, and they were kind of disgusted, and they decided that they're not going to eat McDonald's for like another week or something like that. So this would be a bad day for McDonald's. This comes out, and consumer tastes shift. They say, well, okay, we don't feel so good about eating this stuff anymore. Okay. So that's one thing that can affect their stock price. You can also think about what competitors are doing. So McDonald's does well with all-day breakfast. Now maybe Wendy's gets into the game and they offer breakfast. That could be a bad thing for McDonald's because it's going to eat away at their sales. Or you can think about just totally random things. The CEO wakes up on the wrong side of the bed and makes a bad decision. Just whatever you can think of, he just makes some kind of boneheaded mistake. That could lower McDonald's stock price. Okay. So we have all of these different things that could all be driving the wiggles in the red lines on our figure. You can think about the same type of stuff for Google. So what's Google's bread and butter? It's going to be ad revenues. Google displays lots of search results. People pay so that their links show up at the top of these results. If people are spending more money, the advertisers are spending more money, and Google gets more of that. Okay, so that's one thing. When ad revenues are high, that's good for Google's business. You can think about new products as well with Google, something like the self-driving car. They're working on that. Maybe this works out well and it generates positive returns. Maybe it becomes a flop and it fails. Maybe Uber gets there first or whatever, and it doesn't do so well. Just like you can have kind of the CEO making mistakes at McDonald's, you can also have similar things at Google. Maybe the CEO says something kind of imprudent and upsets some people, and now people don't want to put their money on Google anymore. People don't want to use Google. Or maybe the CEO upsets some kind of politician, and now tech has to worry about antitrust kind of regulations coming down the line. This is something that's is conceivable. If a tech says something wrong or does something that politicians don't like, then maybe that's a risk that could hurt their stock price. And kind of along those same lines, you can think about public trust. Everyone puts a lot of trust in these tech companies, and who knows, a news story comes out and that could hurt their trust. Okay, so we have all these things that move Google stock price. We have all these things that move McDonald's stock price. We want to try to classify these a little bit into our categories. Which of these are systematic and which of these would be considered idiosyncratic? Well, for McDonald's, people's restaurant spending is probably pretty systematic. Right? You only go out to restaurants if you have money, right? If things are going well, you have extra cash to spend, you can go out to the restaurant. Or it could be that you're very busy at work. You've got, you're hours are long, so you don't have time to prepare food at home. Instead, you outsource it and you go to a restaurant. So that would be something that's tied to the overall economy. When the overall economy is doing well, people are willing to go to restaurants more. Kind of similar along those lines, new products will do better when the overall economy is doing well. If people have more money, they're more likely to try out new products, they're more likely to buy this all-day breakfast. Moving down the list, however, we move into things that are not systematic. So this documentary, for example, that's a very specific thing to McDonald's. Right? That has nothing to do with the overall economy. This is just a very bad day or bad year probably for McDonald's, as people realize that this stuff is kind of not very healthy if they didn't realize that already. Likewise, if a competitor gets into your business and tries to take away some of your sales, well, that's not a systematic thing. That's not something that's caused by the overall economy. That's just a very small subset of the market. Wendy's is trying to take away some of your profits. Or if the CEO just makes a bad decision, again, it's not because of the overall economy that this is happening. It's just a coin flip, right? Sometimes the CEO makes a good decision, sometimes bad. It's just kind of random. Turning toward Google, well, the ad revenues, that's their bread and butter. That's very systematic. When people are spending more money, advertisers are willing to spend more on advertising, and that's going to drive Google's stock price. Similar with new products. If they develop this self-driving car, they're not going to be able to sell it in a recession, right? You're not going to buy a new car, especially a new kind of high-tech car, if things are going badly. You're only going to do that if things are going well. So this would be systematically risky. We can move down and if the CEO just kind of blunders a little bit, well, that's not due to the overall economy. That's just you got unlucky one day. Again, public trust and antitrust regulations, these are probably not driven by the overall economy. These are just kind of idiosyncratic things that could lead to bad days for Google. So we have all these different wiggles, and we'll see how they kind of interact. So there's not necessarily going to be a relationship between the supersized documentary and, say, antitrust regulations, right? Sometimes McDonald's does bad, at the same time Google does well, right? There's not a relationship there. Conversely, these things in bold, these first 4 points, those are going to be moving together. When the economy does well, people are going to be eating more at restaurants. They're going to be spending more on advertising. Right? So both McDonald's and Google are going to be moving in the same direction there. So if we bring up this picture, we can think about all the different wiggles here. Sometimes, Google has a very bad day here at the end of 2013, beginning of 2014. Google's stock is dropping, but McDonald's is doing fine. So when you buy a portfolio of 50-50 Google, 50-50 McDonald's, it goes down a little bit, but not that much. Not nearly as much as if you just owned Google. Other times, they're moving together. So if you look at the very beginning, the red and the blue lines are generally trending up, say from the beginning of 2011 through the end of 2011. They're all going up at the same time. And that trend generally continues through 2012, right? That both McDonald's and Google are moving kind of in parallel to each other. So that would be a case where those systematic risks are driving both, whereas when we have this kind of big drop in Google, that's something that's just idiosyncratic to Google. It doesn't look like that is a systematic thing that would also affect McDonald's because they're kind of moving in opposite directions. You can also find cases where McDonald's is doing kind of poorly here in the end of 2010, but Google is doing fine. And so these idiosyncratic wiggles kind of cancel each other out. What we have left is this green line that smooths out all of those wiggles, except for the systematic risks. Okay. The other thing to note with diversification is that you can get a lot of bang for your buck with a small portfolio. So here I took just 4 stocks, NRG, Tesla, Luby's, and Honeywell, and then I created a portfolio that just equally weights the 4 of them. And you can draw out their returns over time from 2014 to 2019. You can see that there's an awful lot of variation. So something like NRG has a bad beginning of the period. That 2014, 2015 is very bad for them, but then they rebound very strongly. Honeywell, on the other hand, does very well throughout kind of the entire period. Luby starts off strong, but then kind of tanks at the end. Right, so there's a lot of variation across stocks and within stocks over time. When you put all of them into a portfolio, we get a much smoother picture. Right, this dark blue line doesn't move nearly as much as any of the other kind of 4 lines. It's much smoother. But no portfolio can avoid the market-wide movements. You can avoid a lot of the wiggles and a lot of the randomness, but you can't avoid those systematic things that drive everybody's stock price. Another way to see this is with this picture. On the y-axis, we have the sigma. This is the total risk for a portfolio. On the x-axis, we have the number of stocks in a portfolio. Now, if you just have one stock, then you're taking a lot of risk. You're taking the systematic risk for that stock, but also all of those unique idiosyncratic things that drive the stock price. As you add more and more risks, however, or as you add more and more stocks, we see that the total risk starts to drop. The reason is all of those coin flips start to cancel out. All those idiosyncratic things, all those wiggles start to cancel each other out. The total risk, this blue line, then converges to the systematic risk. The systematic risk is what affects everybody. It's tied to the overall economy, so you can't get rid of it. The blue line is going to converge to that. You don't need like 1,000 stocks. You can see that the total risk converges pretty well with only like 20 stocks. It converges to the systematic risk in the portfolio. Okay, so you get a lot of bang for your buck with just a handful of stocks. It can move things. I can get rid of all of that casino type risk. The unique risk is the difference between the systematic risk and the total risk. Right? The unique risk is all of those things of the supersized documentary that are just unique to McDonald's. You can get rid of it, so there's really no reason to hold on to it, and you're not going to earn a return by taking that kind of risk. Next, I want to talk about quantifying systematic risk more precisely. So we've talked about kind of big picture. What are the types of risks? We get paid for the systematic risk, not the idiosyncratic risk, but we still need a way to quantify that and use the quantity to find the expected return. We know that we get paid for systematic risk, so if we can put a number on that, we can translate it into a discount rate, which is the point of this lecture. To do this, we're going to use something called the CAPM, the Capital Asset Pricing Model. That's going to be our workhorse model. What we're after is the risk premium. How much do you earn by taking risk? How much do you earn above what you could get without taking any risk at all? We said that this depends on the type of risk. Right? The idiosyncratic risk doesn't earn any return at all. Systematic risk is what earns a return. Bringing this back to corporate finance, you should remember that if you're a financial manager, your bosses are the investors. And so if they're diversified, they don't care about the idiosyncratic risk, so all we should care about is the systematic risk. We have to quantify this. How much of a risk premium should we get? Well, that depends on how much systematic risk are you taking. Different investments are going to have different amounts of systematic risk and hence different risk premiums. The second ingredient, besides the quantity of risk, is the price of risk. So how much do investors expect to get when they take systematic risk? Okay, that's not something that you determine. That's something that's set by the overall market. Right, the stock market is a competitive place. Investors require some return in order to take risk. That price of risk is set, and then you multiply that price by how much risk you're taking, to get your risk premium. How do we measure systematic risk? We know that it's the relationship between your assets return and the returns of the entire economy. How do we get the returns of the entire economy? Generally, we'll use something like the S&P 500. The S&P 500 is a basket of all the biggest stocks. So when that moves, we generally think that that moves with the overall economy. So we want to get the relationship between your asset and the S&P 500. The CAPM is a way that we can measure this. The CAPM is a one-factor model. So the only factor is what's going on with the overall market. And it measures the sensitivity of your investment I to the overall economy. That sensitivity is called the beta. Now, the CAPM is not the only model in town, but it's the starting point. It's the workhorse model. There's lots of other models that kind of build off of it. But for our purposes, it's all we need to estimate the expected return for a stock. The CAPM has three basic ingredients. We have the risk-free return. That's how much you can earn by not taking any risk at all. So think of the US Treasuries. Right? The US Treasuries are very safe, so you can earn a return just by buying government debt. That return has no risk, so that's going to be one ingredient. The second ingredient is called the market risk premium. RM is the return on the market. How much do we expect to get on the market minus the risk-free rate? So this is how much extra you get by holding the S&P 500. The final ingredient is the beta. The beta is subscripted by I, so that means every investment I could have a different beta. This is the quantity of systematic risk that you take with project I or investment I. So if we can put all this into a formula, let's see how these things can relate to each other. What we're after is the expected return on asset I. The starting point is going to be the risk-free rate. If you're going to take risk, you should at least get the risk-free rate. That's the kind of a natural starting place. We're going to add to it, though, if we take risk. How much do we add to it? Well, we're going to have beta, which is the quantity of systematic risk that we take, and we're going to multiply that by what's called the market risk premium. This is the expected return on the stock market. Again, think the S&P 500 minus the risk-free rate. Another way to say this, the expected return on I is the risk-free rate plus beta times the market risk premium. That's this whole term here. It's the premium that you get over the risk-free rate by investing in the market. Another way to say this is the return on I is equal to the risk-free rate plus the quantity of systematic risk that you take. That's beta multiplied by the price of systematic risk. Investors in the stock market have determined that they're willing to take that risk as long as they earn this return. Right? That's the price of systematic risk. The quantity of systematic risk is how much systematic risk your particular investment is taking. So you put these two things together to get the premium over the risk-free rate, and that gives us the expected return on your asset I. Okay, so we've talked through the derivation for this formula, kind of the intuition. Next, I want to make sure that we can plug in numbers and get the right answers. So suppose, and I'll mention real quickly here, that when we do this, it's important to note that the only thing that changes from one investment to another is beta. Okay, that's what's important from, if we move from Apple to HEB or something like that. Different investments are going to have different systematic risks. The risk-free rate, that's the same for everybody. If you want to use the CAPM to calculate the expected return on Apple versus the expected return on HEB, you're going to use the same risk-free rate because that's determined solely by the treasuries. Likewise, you're going to use the same market risk premium. The expected return on the overall stock market is the same, right? It doesn't change when you're trying to evaluate HEB or Apple, right? It's just whatever is happening on the overall stock market. So the only thing that changes is the beta. Okay, so let's do that for this example. Let's plug in these numbers to get the expected return on investment I. This investment has a beta of 0.67. You know that the risk-free return is 1.5 and the market risk premium is 6.75. So we're just going to plug all of this into our equation to get an expected return of about 6%. We can do this for a bunch of different securities. According to the CAPM, the only thing that changes is the beta. So we can think about 3 different investments, 1, 2, and 3, with a beta of 0.5, 1.25, and 1.34. They all share a common risk-free rate and a common market risk premium. Those are just given by the economy. Calculate the CAPM formula for each of these using the different betas. We get different expected returns. We get an expected return of 5.5 for the first one, 10.75, and 11.37. As you take on more systematic risk, your beta goes up, and therefore your expected return should go up as well. To compute the beta, we know that it's this sensitivity between your investment I and the overall market. So statistically, we could measure this as a covariance or a correlation. We're not going to do this. This is a little bit too much statistics for our class. But the idea is you want to know how these things co-move. I want to talk about it a little bit more intuitively. If the beta is the relationship between an asset's return and the overall market return, then we can just compare these two things to get an estimate of the beta. So for example, suppose an asset moves 1% during a month, where the market moves 2%. If this is all you know, that during 1 month, your asset moves 1% and the stock market moves 2%, what could you do to calculate the beta? Well, you see that the asset moved half as much as the market. So a reasonable guess is that the beta is a half. That would be just an estimate from 1 month of data. Now consider that you have a bunch of months. You have 60 months worth of data. You could do the same exercise every month for 60 months and then just average the result. You get a half 1 month, you may get 1 another month, minus 1 another month, and then you just average everything together to get the average sensitivity of your asset to the market. So I want to show that in Excel next to see how that would look. Just taking the numbers from the slide previously, we saw that our asset moves 1% when the market moves 2%. So what would be our guess for the beta? Well, it'd be 1 divided by 2. What's the sensitivity of our stock to the overall market? It would be a half. Our stock moved half as much. Suppose our stock moves 10 at the same time that the market moves, say, 15. What would be the inferred beta here? Well, it'd be about 2/3. Our stock moved 2/3 as much as the market. Okay, so in this month, in the second month, our stock looks a little bit more systematically risky, right? It moved more with the market than it did that first month. We can try this again for maybe a negative number. Maybe our stock moves down 5 at the same time that the stock market moves down 2%. So what would be the inferred beta? It'd be about 2.5. Our stock moved a lot. It moved 2.5 times as much as the market. So what would be one natural thing to do in order to estimate the beta for your stock? Well, you've done it 3 times for 3 different months. What you can do is just average these things together. Take the average of those 3 betas of about 1.2. And so that would be kind of a reasonable guess as to the beta of your company. That's the average relationship between your stock and the overall market. I filled this out for kind of a bunch of months. If you have a stock market return in this column and the market return in this second column, you compute the beta. I did this 60 times just to estimate, say, 5 years worth of data. 12 months in a year times 5 years, that gives you about 60 months. You can calculate beta for every month. You get an average beta of 1.09 here. Now, the other way that you can calculate the beta is to plot returns against each other. That's what I did with this figure here. I'll make that a little bit bigger for you. I just picked a bunch of stock returns and overall market returns, and then I plotted them against each other. Put the market return on the x-axis, it's going between 4% and 6%, and then I put our stocks return on the y-axis, goes from minus 10% to about 10%, and then I plotted the relationship between them. What's the average relationship between the overall stock market and our individual security? And we get this relationship. We get y is equal to mx plus b. If you remember your algebra, this is the equation of a line. So y in this case is our stock. That's what goes on the y-axis. How much is our stock moving every month? It's equal to 1.3 times x. X is the market return. How much is the market moving every month? 1.3 is that average relationship. So when the market moves 1%, our stock is moving about 1.3%. Okay. That's pretty close to what we calculated over here of 1.1. We calculated this beta just by calculating a guess of beta every month and then taking the average. You're going to get roughly the same thing when you do this scatter plot and draw a fitted line there. I want to walk through this scatter plot step by step because it's a very nice way to estimate the beta, and you can do it for any company that you want very easily once you download their data. Okay. So let me do that for ExxonMobil, and I put the directions for doing this up on Teams. So if you go in Teams in the review material folder, there's that Excel practice file. It has all of the sensitivity analysis we did with the auto buy example. It has the future value calculations and present value calculations, all of that stuff. There's also a tab for calculating the beta, for estimating the CAPM using stock return data with detailed instructions there. So you should check that out. I'm going to walk through it once. It's also in the slides. So if I pull up the slides again, we have this kind of intuitive way to estimate beta. It's just a relationship between the stock and the overall market. We can calculate it more formally by downloading data for the stock. To get data, you can go to a variety of sites. I like Yahoo Finance. You go to Yahoo Finance, just finance.yahoo.com. You can search for any stock that you want. So I'm going to search for ExxonMobil, XOM. Here's a bunch of information on Exxon. I want to get the stock price data. What I'm after is how the stock price for Exxon moves with the overall market. So I click on this historical data tab here. That's going to show me what the stock price has been in the past. Here's the stock price for today, the open, the high, the low, the close, the adjusted close, and the volume. Okay, so all sorts of data. I want to get data at the monthly frequency. When the data is daily, it's a little bit too noisy. So we can't estimate the relationship between the market and Exxon very well. So the typical practice is to use monthly data. And you can do this for any kind of time horizon that you're interested in. In the slides, I think I go back to 2014 through 2019 to get a 5-year period. That's a kind of a typical period, a 5-year period. I'm going to update those filters, and Yahoo gives me all of the data that I asked for. I just download it, click the download button. It gives me a CSV file here. I can open that. And there's all the information for Exxon. I get the monthly dates, the open price at each month, the high price, the low, the close, the adjusted close, and the volume. So this is all for Exxon. But remember, for CAPM, I also need to get data on the market. I need to know how the market is moving at the same time Exxon is moving. So in this example, my stock I is ExxonMobil. I need to compare that to moves in the stock market. So I'm going to pull back up Yahoo Finance, and I'm going to download data for the entire S&P 500. In particular, I'm going to use the SPY ETF. This is a ETF that just buys a basket of all the stocks that are in the S&P 500. So I get the same data that I got for Exxon, right? So you go to historical data, you download the monthly data for the same time period. Okay, so I already did that. I'm going to pull that up in the spreadsheet. Okay, so that's all here. I have all the data I downloaded from Exxon in these first columns. And then I have the same data for the S&P 500 in the next columns. I just pasted them right next to each other. I don't care necessarily about the opening price, the high price, or even the close price. I definitely don't care about the volume. I'm going to keep the adjusted close. Okay. So what is the adjusted close and why is that different? Well, the adjusted close is accounting for dividend payments. What you want is you want the buy and hold returns from buying Exxon or buying the stock market. If you ignore dividends, then you're going to be ignoring part of your returns. So if all you're going to do is look at the closing prices, say, well, you're going to miss any dividends that get paid in between, right? The dividends are not going to show up in the closing prices. Once you get the dividend, then that cash flow is no longer part of the price. Okay, so it's going to look like the prices didn't earn that much of a return if you don't account for the dividends. So that's what the adjusted close is doing. That's all it's doing in Yahoo Finance is it's adjusting for the dividends that you're getting and building those into the returns. Okay, so I'm going to get rid of everything except the adjusted close. I have the adjusted close for Exxon and the adjusted close for the S&P 500 index. And then I have the date. These dates lined up. You have to make sure that you line up the dates. So I downloaded the data for Exxon and the S&P 500 for the same date range. Okay, so now I've got a bunch of prices. What I need, however, what shows up in CAPM are not prices, but returns. Right? I need to find the return on Exxon and the return on the stock market and compare them to each other. So in column D, I'm going to calculate the return on the SPY, and then E, I'm going to calculate the return on Exxon. And how do you calculate a return? Well, it's just the change in price divided by the original price. So for the S&P 500, in December 2014, it was at 182. It had started at 184. So 182 minus 184 divided by 184 is going to give us the return. Okay. And then same thing for Exxon. So in that first month of my data of November of 2014, the S&P 500 went down by about 80 bips, and the ExxonMobil stock went up about 2.8%. Okay, so I'm going to do that for every single month in my data. I get a whole host of returns for the S&P 500 and ExxonMobil. To estimate the CAPM, I'm simply going to plot these returns against each other to see the average relationship between the S&P 500 and Exxon. So in Excel, I can create a scatter plot. I go to the Insert tab at the top, and then there's a little scatter plot here you see in the Charts section. I click on that, and then I'm going to kind of choose my data. I'm not going to plot the prices, right? I don't care about the price of Exxon or the price of the S&P 500. I only care about the returns. And in fact, what I'm going to do just to make things a little bit simpler, I'm going to get rid of that one. And I'm just going to highlight these two columns. And if I just highlight those two, then it's going to be easier to create the graph in Excel. So I'm going to insert this scatter plot. And when I highlighted it, it's automatically going to give me exactly what I wanted because I only selected those two columns. And so it knows exactly what to do. On the x-axis, it's putting the S&P 500. And on the y-axis, it's putting ExxonMobil. To clarify, I'm going to add some chart elements. I'm going to put titles on the axes. So on the x-axis, this is the SPY return. Make that a little bit bigger. And on the y-axis, we have the ExxonMobil return. Okay. To get the average relationship, I'm going to ask Excel to fit a trend between these two things. So I'm going to click on these little dots. I'm going to right click, and we're going to click on this option to add a trend line. It's going to be a linear trend. I'm going to display the equation on the chart just so I can see what's going on. I don't need the R squared. Okay, so there's the equation. Make that bigger. This is the equation of a line. This tells us that Exxon, the Y variable, generally moves 90% of the X variable. The X variable is the market, the S&P 500. So that tells us that Exxon is moving about 90% of the market movements. The beta here would be 0.9. That's the sensitivity of Exxon to the market. It's 0.9. It doesn't quite move as much as the market. It moves 90% as much as the market, kind of on average. Okay. So that's one precise way to estimate the beta. That's more precise than doing this kind of division that we did before, where we have the Exxon divided by the S&P 500 and doing that a bunch of times. That kind of gets you in the right ballpark, but it's a little bit better to fit this trend line more formally. So that's all laid out in the slide deck. You download the prices, you calculate the returns, that's step 3. Then you draw the scatter plot, step 4. And then you fit the trend line, that's step 5. I think I used slightly different data. When I did it before, I had a slope of 0.93 versus 0.90. So the conclusion from that, the bottom line, is that Exxon is moving about 90% with the market. Okay, so that gives us a beta of about 0.93. You can do this for a bunch of different stocks. So for Exxon in this sample, it was 0.9. If you were to do it for Amazon for the exact same sample, you would get a beta of 1.5. So that's a higher beta, right? The slope is higher for Amazon. It's 1.56 instead of 0.9. That's the sensitivity, that's the beta. You could do it for CenterPoint, right? This electric provider, a utility. You get a much lower beta, only 0.46. So on average, when the market moves 10%, CenterPoint moves only 4.6%. Right? That's the average relationship between the market and CenterPoint. It's much lower than the other two. To summarize these plots, on the x-axis, we have the return on the stock market. On the y-axis, we have the return on our asset, Exxon in this example. The slope here, the slope of that line, gives us the beta of 0.93. That's the sensitivity of our stock to the market. That's capturing the systematic risk. How exposed is Exxon to the overall market? Now, there's other risk. We talked about different types of risk at the very beginning here. In particular, think about all these dots here that don't fall on the line. The line, the slope, is picking up the systematic risk. So all the points that are off the line must be some other type of risk. That's the idiosyncratic risk. These are the kind of good days and bad days for Exxon. This point up here, that's a very good day for Exxon. The stock market didn't move up very much, but Exxon moved up almost 10%. So something good must have happened that is specific to Exxon in this point. Kind of conversely, if we look at this point down here, stock market didn't move down much, but Exxon went down almost 15%. So this is a bad day. Something kind of idiosyncratically bad happened to Exxon, and that's why we're all the way down here. You can see that kind of on average, the good and the bad kind of net out. And of course, if you diversify your portfolio, that's going to happen, even more quickly. Okay. And that's true for all of these different stocks, right? Amazon has got a lot of idiosyncratic risk. The line is picking up the systematic risk, which is quite high, but there's even more idiosyncratic risk for Amazon. And even Centerpoint. Centerpoint has a pretty low systematic risk, beta of 0.46, but you still get a fair amount of idiosyncratic risk here. Still a fair amount of variation, these points that are not sitting on the line. Now I want to think about the fundamental drivers of beta. We just saw 3 examples, 3 stocks that had very different betas, 1.5, 1.5. Here's a bunch more stocks. Right, Amazon's at the very top. Then we have Southwest has a beta of 1.39. I estimated for the same sample the beta for all of these stocks. We go down to Centerpoint's at the very bottom. McDonald's is about 0.48. Anthem is 0.74. The question is, what are some trends here? Do you see anything off the top of your head? And what can that tell us about the fundamentals of these businesses? You may notice, Amazon's at the top. Well, why is Amazon exposed to systematic risk? Why do they have a high beta? You may think that people buy more stuff. They go on Amazon and they buy more stuff when things are good. When the economy's going well, you buy more stuff. Conversely, if you think at the very bottom, Centerpoint, well, Centerpoint is our kind of electricity provider, our utility provider. If things are bad and you lose your job, you're still going to have to pay for AC. Right? You're not going to make it through a Houston summer without air conditioning, so you're still going to be buying electricity. Maybe you can cut back a little bit, keep your thermostats at a higher temperature than you otherwise would if things are bad. But there's a limit to how much you can cut back here. Okay, so Centerpoint has a low beta, presumably because people don't alter their spending on electricity that much during recessions versus booms, whereas they may fly a lot less. So Southwest has a pretty high beta of 1.4. Things are good, you're going to go on vacations, you're going to visit people more. If things are bad, that's going to be one of the first things that you cut out of your budget. Same with Netflix. That's an easy expense to cut out if things are bad. Home Depot is about a beta of 1. When the economy is doing well, you do more home repairs, but maybe you don't scale up and down quite as much as you would with Southwest or Amazon. Okay. We have some restaurants down at the bottom, Luby's and McDonald's. We know that they have some systematic risk, but it's not particularly high. It doesn't seem like that's the first place people go to cut is their spending at Luby's. That brings us to 2 fundamental drivers of beta that I want to talk about more. The first is the correlation of kind of sales with the business cycle. That was the one that pops out immediately when you look at this list. People are more likely to spend money when things are good. You're not going to cut back on your electricity. Okay. But there's another fundamental driver that can drive that reflects beta. So let me pull up the whiteboard here. What drives stock valuations? Remember, it's about cash flows. What is happening to the cash flows of the company? If the cash flows are cyclical, then you're going to have a high beta. When the overall economy does well, your cash flows are high. When the overall economy does poorly, your cash flows are low. That would be a high beta stock. So what could drive these cyclical cash flows? Well, the first thing would be revenues, right? If your sales go up and down in a very cyclical way, then you're going to have cyclical cash flows. So let me just draw a picture to show what I mean. Okay. We're going to plot over time what's going on with like revenues. Okay, so on the x-axis, we're going to have time. On the y-axis, we're going to have kind of dollars. And what are we going to plot? We're going to plot the revenues for a company. Let's say it looks like this. It's very cyclical. It's going up and down with the overall economy. Okay, so if your revenues look like this and they're very cyclical, then you may have a high beta, right? That's going to drive cyclicality in your cash flows. What would be something else that could drive cyclicality in your cash flows? Well, remember that the cash flows that the company is generating, roughly speaking, we're not going to go into the details of free cash flows again. Kind of roughly speaking, you can think about your revenues minus your expenses being your cash flows. Obviously, we know there's CAPX and there's other, net working capital and stuff that goes into it. But just being very kind of coarse here, we have cash that we're taking in, our revenues, and then we have cash that we're spending, our expenses, and the difference is going to be the cash flow, the net cash flow. So when is this thing cyclical? When will the cash flow be cyclical? Could be that the revenues are cyclical. However, we also have to keep track of our expenses, right? Revenues are only one side of this puzzle. What could be happening with expenses? Well, suppose this is what's going on with your expenses. We have expenses in red, revenues in blue. What you see is our expenses are moving kind of one for one with our revenues. We're able to scale back our costs when our revenues drop. What's that going to do to our cash flows? Well, in fact, we're going to have very safe cash flows. We're going to have cash flows that are pretty much just constant. Labeling this here. So it's not necessarily enough to have cyclical revenues. If you're able to cut your costs when things are bad, if you have high variable costs that you can cut when things are bad, then what you can do is you can flatten your cash flows. And now your cash flows don't have much risk because revenues and expenses are moving one for one. So that means that we've got kind of two things to consider. Cyclical revenues are one thing that could drive cyclical cash flows. The other thing would be high fixed costs. Right? So if your costs are variable, variable costs means that they move up and down with revenues. And your cash flows are going to be pretty constant. However, if your costs are fixed, meaning you have to pay the same cost no matter what, no matter how much revenue you generate, you have to pay the same costs, that means that your cash flows are going to be more cyclical. Okay. So in this case, we have kind of high variable expenses. And the result is very safe cash flows. But suppose we have high fixed costs. then it's going to flip. Right? If we have high fixed costs, now we're going to put those in green. And then the cash flows are going to be what's left over in red. We're going to have very cyclical cash flows if our expenses are fixed and you have to pay the same expense, good times or bad. Okay. So those are the two basic drivers of beta: the correlation with the business cycle and what we call operating leverage. Operating leverage is just a fancy name for high fixed costs. Okay. The first driver is relatively intuitive. If your products are highly correlated with the business cycle, you'll have a high beta. So with Apple's not going to sell very many iPhones during a depression. Right? The first thing that you can do to cut your spending is to just not buy that new iPhone. Don't buy the $1,500 iPhone. You can make do with your old phone for a little bit longer. So things like consumer durables, phones, cars, these are pretty cyclical. You can always make do a little bit longer using your old car, using your old phone. So that means that the demand is going to be very cyclical here. Whereas products that people need to buy all the time, like electricity, that's not going to be very cyclical, so you're going to have a lower beta. Likewise with operating leverage. If you have high fixed costs, then you're going to have very cyclical cash flows. If you have high variable costs, then you're going to be able to cut your costs when things are bad, and that's going to smooth out your cash flows. Okay. Finally, I want to wrap up with some caveats in the capital asset pricing model. There's going to be three things to keep in mind when we use CAPM. The first is historical versus future betas. When we drew those scatter plots, we were estimating those for a certain sample. Our estimates may change if we use a different sample. Okay. The second thing is that when we estimated CAPM, we were doing it for equity, but a company may have debt as well. And so if you're estimating the discount rate for the equity, we have to remember that the discount rate for the debt is also going to be important for the company's average discount rate. And then along those lines, when we use equity, we're estimating it for the entire company. Right? All the company's equity gets embedded in the stock price, which is what we use to estimate CAPM. If the company has multiple divisions with different levels of systematic risk, then that company-wide measure is not going to be appropriate for each of those individual projects. Okay, so let's focus on those one by one. When we estimate betas, these are historical because we're using historical data. You have to pick some time frame to estimate the relationship between your stock and the market, and there's really no way around that. What we're interested in with discount rates is the future, right? We want to get the expected return. Our best guess is to use historical past data. So that's obviously a kind of data limitation. We can't know what we expect to get in the future. We only have past data, but that's kind of the best we can do. If you have a new firm, then you actually have no data. Right? So you have to figure something else out. Maybe you can think through the fundamentals of the business. You can think through, again, the cyclicality of the revenues or the operating leverage of the company. Try to estimate the systematic risk. You can also look at kind of similar companies, but you have to be a little bit more creative if you don't have appropriate data. Okay. So for an example, when I estimated the beta for Southwest, I was using 2014 to 2019, and we got a beta of about 1.4. If you were to do that same exercise from 1999 to 2004, you'd get a beta of only 0.8. Okay, so now obviously Southwest has grown a lot over time, and so that's probably part of it. They've expanded now. They're not just a regional player. So that could have been driving the increase in systematic risk from 1999 to 2014. But the point is you can get decent swings in your betas if you're using different samples. The second caveat has to do with debt. When we estimated betas, we were using the equity, but we know from the balance sheet identity that the assets are financed using both debt and equity. So if we want to get like a discount rate on the assets, it's going to be a combination of debt and equity. And we can't just rely on the return of the equity to discount assets. This is going to be the big focus of our class after the second midterm. We're going to be studying the returns on each of those components of the balance sheet identity. And finally, when we estimate the beta for the equity is for the entire company, right? Now that company may have multiple divisions. When we use the company-wide beta, we have to make sure that that matches with the project that we're discounting. Okay? So it would be wrong to use the company cost of capital for projects that don't have similar risk as the entire firm. So let's see that in an example. Consider a conglomerate that is financed with 100% equity. So because it's 100% equity, we can get rid of that problem where there's debt and equity kind of mixed together. Here it's simple, we have 100% equity, but there are three large divisions. We have a car dealership division, that's 1/3 of the company. We have a dental equipment division, that's another 1/3 of the company. And we have a utility division, that's another 1/3 of the company. Each division has a different beta. We said that cars are durables, so that means that they're relatively high beta. The demand is pretty cyclical. The dental business has a slightly lower beta, and the utility business we saw with Centerpoint has a very low beta, very low demand cyclicality for electricity. How do we combine all of this to get the overall risk of the company? Well, we're just going to take a weighted average. So 1/3 of the company has a beta of 2.5, 1/3 of the company has a beta of 1.5, 1/3 of the company has a beta of 0.5. So that means that the average beta is going to be about 1.5 for the company. You average all these betas up, you get 1.5. So if you use that, that works fine for the dental business, but you don't want to use a beta of 1.5 to discount the car projects or to discount the utility business, because then you're leaving money on the table. Right? If you use a beta of 1.5 to discount the car business, then you're going to be taking on kind of bad projects. You're going to be using too low of a discount rate to discount these risky projects. Like the average discount rate is going to be much lower for the company than in its riskiest division. And so you're going to be taking on too many car projects that earn a return that's above the company average, but below what you need to compensate you for the risk of the car business. You can do this on the opposite side. If you're using the company-wide average beta, then you're going to be passing up on very good utility projects, because utility projects are very safe. So you only need a beta of 0.5. If you require that all of your projects pass the beta of 1.5 threshold returns, then you're going to be passing up good projects in the utility business. So suppose you're a financial analyst in conglomerate's headquarters and you've been asked to evaluate a project in the electricity generation business. What opportunity cost of capital should you use for that project? Well, we saw that the beta is 0.5, we have a risk-free rate of 5 and a market risk premium of 6. So the discount rate should be 5 plus 1/2 times 6, that's going to be 8. Right? You should use a discount rate of 8% in the utility business. Conversely, you should be using a discount rate of 13% in the dental business. You don't want to use a discount rate of 13% in the utility business, because then you're going to be missing all of those good projects that you could take in the utility business. Okay. That's everything for the caveats for CAPM. We're going to be using this kind of throughout the semester to be thinking about the systematic risk for different projects.